Okay, so hello everybody, and welcome to the session number 33 of the CEBRA annual conference on fintech and financial inclusion. This is a session sponsored by the Bank for International Settlement. I am Leonardo Gambacorta, the head of Innovation in Digital Economy at the BIS, and I have organized this session together with my colleague John Frost and Tatiana Didier from the World Bank. We have selected the 4 papers for this session. We have no discussant, so we can take directly questions from the audience. We have scheduled 20 minutes for each paper. After each presentation, I will collect a few questions, and the authors will give us a short answer to this question. And just to remind you that I can collect the question via the chat function, or if you wish, you can raise your hand and I'll give you the floor. So I think that we can start with the first paper. The paper is on which lenders are more likely to reach out to unserved consumers. The paper provides a nice comparison between banks, fintechs, and other non-bank financial institutions. The presenter is my friend and co-author Julapa Jagtiani from the Federal Reserve of Philadelphia. The paper is joined with Erik Dolson. Julapa, the floor is yours. You have 20 minutes.
Thank you very much, Leonardo. Good afternoon, everyone. As Leonardo said, I'm a senior economic advisor at Philadelphia Fed, and just wanted to remind everyone that everything I say today is my own view, not the view of the Federal Reserve Bank of Philadelphia or the Federal Reserve System. So I am going to share my slides. Okay, I think you all see this okay, right?
Yeah, we got you.
So this is co-authored with Erik Dolson at Philadelphia Fed as well. And thank you very much for this opportunity to present my work, Leonardo. Thanks for accepting the paper. Oh wait, so how do I move this? Ooh. Excuse me, one moment. Let me share the PowerPoint slides instead, because I couldn't move the slide. Okay. Now, how do I make it full screen? It doesn't matter, right?
We can see clearly the slide. If you want to go in modality,
yeah,
it's clear. We can see
okay, so in the last 4 or 5 years, I have been doing research related to fintech and have focused on the roles of alternative data and machine learning, and looking at fintech data, data from fintech lenders like Lending Club, and look at whether actually fintech lenders have any comparative advantage by using more data, more complex big data, alternative data, and their complex modeling to identify what they refer to as the invisible prime. People who may have low FICO score or thin file because through the traditional credit rating, they don't have enough record, or somehow they have low FICO, right? But some of these, actually what I found in the past is that sometimes for many people, there is very low correlation between the ratings that fintech lenders assign to them and their FICO score. But there are also many other studies that look at the roles of fintech in lenders in expanding credit access. But so far, all the studies actually look at the loan origination by fintech, like Lending Club have posted their data on their website. Prosper used to do that as well, but now they're not doing it anymore. So we had this some of the this loan origination data, but there have also been arguments that, you know, who knows that these fintechs may be doing more business with low FICO and less credit-worthy customers, because the high FICO consumers actually don't need them. So there may not be that much demand from good borrowers. So the goal of this study that I'm going to present today is to ignore the demand side and focusing on the supply side, and using this unique data set that we have at Philadelphia Fed. So we are going to look at the credit offers. So what lenders actually offer to different consumers through mail, like you're all getting the credit card approval and mortgage approval all the time in the mail. So that's what we are looking at, the supply side of credit. So we can, the next slide shows that this mail volume has been growing, particularly after 2014. So, so this study would compare, so you can see that in 2015 to 18, the volume was rising significantly for all types of lenders, including the traditional banks. But traditional banks actually fall definitely below the fintech lenders and other traditional non-bank lenders. So our data period would look at credit offers during 2015 and 18, and to see where these offers go to, what kind of consumers these different types of lenders are reaching. So just to give you an executive summary of what we found before I even show you the analysis. We find that, so we look at the two types of offers: personal loan, which include and exclude credit card. We have done it both ways, and also mortgage loans. And we find that for mortgage loans, we find that fintech lenders are more likely than banks to offer mortgage credit to consumers with low income, low score, and people who have been denied credit in the recent past. For personal loan, we find that fintech lenders are more likely than banks to offer credit to people who have filed for bankruptcy, and also people who have been recently denied credit. Then for both mortgage and personal loans, we find significant evidence that fintech lenders are more likely than not just banks, but other non-banks as well, to reach out to people who are below prime, non-prime consumers. So that's kind of the finding. Now, as I said, I had some paper that looked at this before, and we found that there was a significant role of alternative data in personal lending and in identifying the invisible prime. Now we are looking at the supply side, lenders' willingness to offer credit to underserved consumers. And so if our hypothesis is correct, then we should find that fintech lenders would be more likely to offer to credit to low score consumers, low income consumers, people who have a lot of credit inquiries and then being denied credit recently, people who are seeking credit, right? And also other people who may have difficulty getting access to credit from traditional lenders, including people who live in a low income area, low score area, low LMI neighborhood, low and moderate income by classification. So we look at all those factors. So the data source, as I said, is a unique data set from Mintel TransUnion. And this is a survey of 8,000 households in each month. So not the same households in each month, but we look at every month of all the 8,000 households that respond on the detail about the credit offers that they receive, right? And in this data set, we have characteristics of the consumers as they reported in a survey. We look at that, we know their zip code, their age, their credit score, their income, but also we have characteristics of the offer itself in terms of the amount of the offer, interest rate, and all that. And so we, the data that we are using in this study includes about 98,000 credit offers, and they're about equal one-third, that we are 35% are from fintech, 31% from banks, and 34% from non-bank lenders that are not fintech. Then we also, the good thing about this survey also is that we have asked Mintel, we received the Mintel data, and then we asked TransUnion to merge it using that consumer's ID, Social Security, to merge it with the TransUnion credit, consumer credit panel. So we get their rating, their score, their delinquency status on all the loans, and a lot of different characteristics from TransUnion about each of the consumers in the survey. We also use Equifax consumer credit panel that we have from the New York Fed subscription available for the whole system to look at the zip code of each consumer to see what would be the average household income in the zip code, what would be the average credit score in the zip code, and also economic condition overall as a control, and to see if some lenders are trying to reach out to the low income area, but actually try to pick the prime, the best consumers in the low income just to get credit for making loans in that area. So we kind of look at different ways. And as I said, the data period is from 2015 to 18. Now, so there also have been from my research papers that look at underserved consumers, I have heard many times, multiple times, people ask, how do you know that they are underserved? Are they supposed to be served, right? So, so here we clearly identify how we define underserved consumers. And so we look at these different income brackets, look at minorities. We identify many different ways just to define what we mean by underserved, and also the credit score being below 660. Also, people who may be living in the area that has low income and bad neighborhood. So we also account for that, and people who actually have been requesting for credit and have been denied. So at least if they're not underserved, we can definitely say that they are credit constrained consumers, and they're desperately looking for credit. So so the way we approach this, we use logistic regression, look at the offer level, loan level, to not loan credit offer, and to compare, because also there have been argument that because the banks and fintechs are actually not subject to the same regulations and capital requirement, and that the different environment. So we're comparing fintech with banks, and also compare fintech with other non-bank institute lenders as well. And we look at two types of credit offers, personal loan and mortgage loan, to see the probability of each offer being an offer from fintech relative to banks, and also a probability of an offer being fintech relative to non-bank. And so what we find, what I'm showing today is really, this is the logistic regression result, that the left-hand side variable is the probability of an offer being a fintech offer. And in this data set, we include only bank and fintech observations, just to compare bank with fintech with banks. And what we find, interestingly, as expected, that The coefficient, you can see I highlighted in yellow, non-prime, prime, and super prime consumers. The best case is subprime, is below prime, right? And so we can see that the coefficient for near prime, prime, and super prime are increasingly negative relative to banks, which suggests that it is this is relative to subprime. So basically, this result suggests that it is more likely to be fintech offers when people are approaching subprime, right? Less likely to be fintech when it is prime and super prime. But also, it's more likely to be fintech offers when people recently filed for bankruptcy, personal bankruptcy, and also it's more likely to be fintech offers when the consumer zip code is consisting of larger percent of minority residents. So I think so. This is for
Julapa, just to alert that you have 5 minutes remaining.
Oh, okay. And then the next slide shows when we also include credit card offers, because the banks actually a lot of offers from banks are from credit card offers, and we find similar results right here. Now, just to give you some story to support what we found is so this is the yellow portion is non-prime consumers, right? And the blue is prime consumers, and we can see that banks are offering most of the offers that banks make to consumers that are basically what sent to prime consumers. And a similar story when you look at the LMI areas and non-LMI, the credit offers that generally go to, a lot of them go to non-LMI area because it's a better area, but again, the similar story that banks are doing less with less subprime consumers. And on here we look at the area with average FICO score in different areas, and we find similar story. Now I'm gonna move a little faster, but we can see that non-prime, non-fintech lenders, that are non-bank, non-fintech lenders, tend to also approach the low FICO non-prime consumers, but we can see that what they charge in terms of interest rate is much higher than any other type of lenders. And so the survey shows kind of a range of interest rates that the lenders are offering, the high end and the low end. So we're looking at both the lowest and the highest, and we can see that the spread is really much higher for non-bank lenders. Now, similarly, we look at mortgage, and mortgage is a different product because we can see it's because of the FHA. So we can see that the highlighted in yellow ones, FHA purchase are mainly loans that were for smaller homes and for lower FICO, generally lower income consumers. And we can see that fintech the offers are more likely to be fintech offers when it's FHA purchase. Also, also people who have been inquiring, requesting credit, tend to actually end up getting offers from fintech relative to banks. And a lot of these offers are for refinancing when we look at this survey. So when we look at the next slide, shows the data set that exclude refinancing offers, and we still find that fintech lenders are more likely to send offers to FHA purchase, which is for smaller amount and for lower income consumers, and also the same for number of credit inquiry. And also for people who have been denied credit recently, also it's more likely that they will get credit offers from fintech lenders. Now, the similar plots are showing telling the same story, but I wanted to go to the conclusion that so overall we find that fintech lenders are more willing to make offers to non-prime consumers regardless of the loan type, and also even when comparing with other non-bank lenders. So there are some policy implications on this that because the President Loretta Mester talk about this, and we have also heard many policy discussions around whether lenders should be actually subject to the same regulations, because they're not, banks and fintechs are not subject to the same constraints. And so should regulation be activity-based or entity-based? And this is a popular quote that, so if it quacks like a duck and walk like a duck, then it should be treated like a duck. So anyway, that's one approach of regulating fintech. But also, alternatively, there have also been, Governor Bowman has been supporting fintech partnership instead of, just kind of, there is this synergy from partnering between bank and fintech, so that 1 and 1 actually add to 3, right? So our results show that if banks are able to access the same technology and better data that fintech has been using through fintech partnership, particularly small banks that don't have access to technology, and they would be in a better position to identify this invisible prime, and also would be more able to make more credit offers to the underserved, just like fintech lenders have been doing. And we actually have been doing a lot of activities here at the Fed with events and trying to kind of help small banks access technology through this fintech partnership. So overall, if that we can promote this bank fintech partnership, we could potentially help banks expedite digitization in banking, particularly during this lockdown. And going forward, everything, the entire landscape has changed. That will allow banks to to offer better products to consumers, and also expanding their consumer base, and also to help them diversify their geographic footprint and portfolio risk and everything. So enhancing consumer satisfaction overall. Thank you.
Thank you very much. Julapa is a very, very interesting presentation, and perfectly on time. I think it's a very interesting paper and very important for financial inclusion. And I also like this discussion regarding the partnership between fintech and banks. And I was wondering, I have just two curiosity. The first one is if in your study you also detect some kind of a pattern in terms of provision of credit, because some studies that we have conducted for China, we see that fintech, they arrive first, and then after there is a little bit of knowledge of on the client, then the bank they enter and they provide additional credit. So if you find such a pattern. And the second question is on regulation. You seem to advocate the possibility to have an activity-based regulation. It's a very nice analogy with the duck. But I was wondering if the same analogy could be done in case of the big tech. So if this only activity-based regulation is, in your opinion, also a possible approach, also when we consider maybe not just fintech but also big tech.
Yeah, big tech is there's more news on big tech and competition every day. Right now, we just heard about Amazon and Google being their lawsuits every day. So yeah, talking about walking like a duck, quacking like a duck, that they should be regulated, treated like a duck. It's easy to say, I think, than actually implement these rules, because it's a very complex idea. The idea is simple, but it's actually to actually do it is very complex, because now you can see that Google is now also offering a deposit account, right? Through partnership with 16 different banks, Google Play, and we also have now challenger banks that Xiang, for example, that offer 12 million credit accounts to consumers without even having a banking license by partnering with banks. So how are we going? I mean, there's so much more detail and to actually nail it down to how to, because each entity it's involved in so many different things, different activities. Payment is another thing, right? Yeah, we'll see how it goes. But it seems to us that, to me at least, that fintech partnership may be the way to go, because then it's really just kind of merging these entities into kind of like one better institutions that would themselves would be more efficient, but at the same time that would also better serve consumers, and there would not be no regulatory issues in terms of it will be the banks basically offering these products, and the banks are already being examined, supervised, and subject to the regulations
really
that the BIS has set.
No, it's a very difficult, let's say, question to answer, because we really move in uncharted water, and we need to understand also certain kind of business model. In the meanwhile, I received a couple of questions for you. The first one, I think, is related with also some descriptive statistic that you have shown. And this is a question by Ricardo. Is a question about interest rates. And the question is, do fintechs charge higher rates controlling for the same borrower and the same other offer characteristics?
Okay, yeah. So that is a very good question. Thanks for asking that. So in this study, I show you the the interest rate that the lenders offer, and you can see that fintech lenders charge the offers are between the non-banks and the banks. The banks would be charging less, but also on average, but not controlling for FICO risk characteristics. When we control for risk characteristics, which is not in this paper, but in the actual loan origination using Lending Club data from my previous study, we find that there are a significant number of consumers who will actually have very low FICO score, classified as being below prime, but actually get rated A and B by Lending Club. And they actually end up getting a loan that is much lower rate than what they would have gotten without this additional alternative data that being used in the credit decision. So no, and also for small business.
No, please complete the answer. There is also another question. I don't want to stop you. Have you completed your answer?
Yeah, I was just going to say that we also observe for small business loan that some of the small businesses actually were able to get very good rate from small business lenders, fintech lenders. Well, there are some others that charge much higher for liquidity, and that so that it varies, depends on the situation.
There is also a very interesting question by Aye Bande Hamadi. And the question relates to if we can have from you any thoughts on if fintech ability to offer this service to the underbanked customers is a result of having lower regulatory related costs, or simply because they are better able than other financial institutions to price risk. Is it because of lack of regulation? Is it because of better quality in the
system? I understand. That's a very good question, but there are some evidence that you could see that many of the fintech lenders actually have applied to become a bank. Like now we can see that Lending Club just became a bank holding company just in the last 6 months. And so while we were 5 years ago, we thought that fintech would disrupt the banking industry and our small banks would fail and everything. Now we are seeing a lot of partnership, and actually Square has become a bank, Lending Club has become a bank. SoFi is applying to become a bank. So while yes, they don't have to hold the capital and liquidity requirements, and they're not subject to the regular examination. Their funding cost is much higher because banks can use deposit to fund these loans, right? And deposit is insured by the FDIC. So banks can fund these loans at a very, very small funding cost, while fintech lenders, I look at their securitization documents and the pricing, it seems like they're paying much higher. At least investors are getting about 7% returns plus their operating expenses and everything. So their funding cost is much higher, and that's why many of them are looking to get access to deposit funding and becoming a bank.
Thank you very much.
Answer your question?
Yes, I think that this answer of yours shed light on a lot of curiosity we have on the functioning of these new fintech providers, and more it has to be done, you know, on understanding the business model of fintech companies and big tech, but we are only at the beginning of this. Thanks a lot, Julapa. Let's move now to the second paper that studies whether and how banks' technology adoption affect the bank lending channel on monetary policy transmission. And the presenter is Yang Li from Halle Institute. And this paper is joined with Iftekhar Hasan. So, Yang, the floor is yours. You have 20 minutes.
Thank you, Leonardo. First of all, let me thank the organizers for including our paper in this wonderful program and in this session. So this paper is still very preliminary, and we would appreciate any comments and suggestions from you. So I assume all the people in this session are very interested in fintech. And fintech is reshaping the finance sector. And compared to the previous financial innovations such as ATM, this wave is special because it was brought by the external players, such as the big tech companies. And for those traditional banks, they are very passive to cope with those new challenges. And at the same time, those traditional banks, they are becoming increasingly enthusiastic in developing their in-house technologies. So this is the first part of the story. And on the second part, in terms of the policy makers, and we have heard many of the monetary policy makers, they have been aware that the fintech has created a brave new world for the monetary policy. And only until recently, we see during the COVID-19 crisis, there are a lot of evidence showing that those technologies will help distribute those government guaranteed credit, which can be seen as evidence that fintech can be used to support monetary policy transmission. Despite those discussions and those small evidence, there is no systematic or a general evidence in the literature to discover or to investigate the impact of banks' technology adoption on the monetary policy transmission. So in this paper, we want to answer two questions. First is whether and how technology adoption will affect the bank lending channel of monetary policy. And the second is what is the rule of the bank's exposure to those competition from big tech players. So to answer these two questions, we have two key challenges, which is the measurement. So we need to have a measurement of the bank level technology adoption, and also we need to consider bank level exposure to big tech competition. And as I will talk about later, the existing measurements for technology adoption is not enough to answer this question. And in this paper, our innovation is to bring in the bank's patent application in specific technology areas to measure their bank level adoption of technology. And we also created this branch-weighted big tech financial service usage as a measure of the exposure to big tech competition. And we found that when we distinguish banks' technology adoption into lending-related and non-lending-related, those lending-related ones will strengthen the bank lending channel. Meanwhile, those non-lending-related mitigate that channel. And among those many technologies, the adoption of cloud computing technologies show the largest transmission enhancing effect. And lastly, the exposure to big tech players will weaken the reaction to monetary policy shocks. So this paper relates to three branches of literature. The first one is on the macroeconomic impact of technological progress in the banking industry. So from this literature, there are many discussions about that, but the evidence is scant and inconclusive, which is mainly due to the difficulty to gauge the operation of multidimensional technologies from the existing measurements based on either PC, IT, or R&D expense. So in this paper, we use the patent-based technology adoption, and this could tell us which specific up-to-date technologies the bank is adopting and what's the purpose of that adoption. Secondly, we also relate to those studies on the sources of heterogeneity of the bank lending channel. So in addition to those liquidity, size, leverage, in this paper, we provide evidence showing that the technology adoption could be another heterogeneity in this bank lending channel. And we consider those progress within the bank and also the competition outside the bank. Lastly, we of course consider the relationship between fintech lenders and those traditional banks. So as you may know, there are a lot of debates and different evidence from the literature showing maybe it's a substitution or it's a complementary relationship. And in this paper, we use the data to examine the role of banks' own technology adoption and exposure to big tech simultaneously. So now let me move to the data part. So in this paper, we use the Chinese banking data. The reason is mostly because of two points. First, the fintech industry is very rapidly developing and is among the biggest players in the whole world. And secondly, we have this bank level exposure to those big tech players, which is represented by the Ant Financial in this paper. So to study the effects of monetary policy, we require a higher frequency data. So we use the quarterly bank data. And as a result, we only have those listed banks who can provide us the quarterly level data. So we have the 19 listed banks from 2008 Q1 to 2018 Q4. And we have the other banks who provide either no quarterly information or is no enough data for that. Although our bank sample is very small, we have included many representative banks in China, and they account for over 56% of total assets in the Chinese banking industry. And then, which is the most key contribution in this paper, is the bank's technology adoption measurement. So as I have talking about, the existing measurement use the IT spending in the hardware, software, or other services, but they cannot tell which specific technology the bank is adopting, and it cannot include most of the recent technology, and it does not include the bank's own invention of that. So in this paper, we use two measurements actually, and the first one, which also used in the baseline, is the bank's patent application in technology areas. I will talk more in details in the next slide. And secondly, we also use the textual analysis of those technological terms in the bank's report as a robustness check. So this patent-based, they are more tangible and they can reflect the actual usage in the banking business. And these two measurements, both they have the feature that they can tell whether the technology adoption is related to lending or not. And it can also tell the 6 categories of technologies. So from the patent-based one, we define the fintech which very broadly as the digital computing technologies that can be used or to be used in financial services. So what we do is research those IPC codes of the patent, those 3 specific patent codes filed by any bank in China. And we select this G06Q classification because it concludes the data processing systems or methods that are specifically adapted for the financing service, so which is very useful to this fintech definition here. And this Q20, 30, and 40, they covered payment, e-commerce, and finance or insurance business. So from this data, we have the full patent files, so including the applicant bank, date, title, codes, and full descriptions. And based on them, we can first classify them into 6 categories, including the artificial intelligence, big data, cloud computing, digitalization, machine learning, and blockchain. And secondly, we can also classify whether this technology adoption is lending related or not. So here are two examples. The first one is the credit business risk monitoring system and the method thereof. This is a patent. And in their description, they have shown that this technology can solve the problem that credit business risk monitoring has strong subjectivity and low execution efficiency. So we decide based on this description that it's lending related. On the second one, it shows this technology can improve the telephone banking transaction and open higher authority telephone banking transactions. So it's not lending related based on this description. So here in this figure, we show the total patents over time, over year, according by category and by lending related or not. So we can see here is a jump in 2013 and 2014. So this is related to our latest story because 2013 is the year for the launch of the Julapa product, which is a key product from the Ant Financial, and it's the beginning of internet finance era in China. And secondly, we see on the right-hand side, the blue line lies well below the dashed red line. So it shows that the lending-related patents, they only take a very small fraction of the whole patent. And on the left-hand side, we see there a lot of heterogeneity across different technologies. And the leading technologies are those digitalization, big data, and machine learning. As I said, we also adopt an alternative measure, which is a textual analysis. And similarly, we can also construct based on the category and whether lending related or not. And they have shown similar patterns by those two measurements. Okay. And then we also need a measure of the bank's level exposure to the big tech penetration. So here, looking at this equation, we basically use the branch-weighted exposure to big tech. So big tech here is the county level usage of big tech, and we weight it by the bank branches according to their geographical location. So we also adjust the time trend issue by using the relative measurement. And so here, if the bank has 2 branches in county C1 and 3 branches in county C2, then their exposure is the weighted one by these 2 branches. Okay. And we also need to deal with the endogeneity of the bank technology adoption by considering the exposure to the big tech. So here, the tech is one of the measurements I have talked about, the patent-based one or the text-based one. And the big tech exposure is just this branch-weighted one. And based on this regression, we use the residual as the technology adoption that is also going on to the big tech exposure. And of course, we also use the red one as the generalization of big tech exposure in our later regression. And lastly, it's about the outcome variable, which we use this long growth. And for the monetary policy shock, which is for China, we use 2 kind of methods to model that. One is quantity-based and the other is price-based. So all you need to know here is that we use the M2-based shock, which is based on this AER paper to use as a measure for the monetary policy shock. And a higher value, a positive value of that indicates an expansionary monetary policy shock. Here is the time series for these shocks. And finally, we come to the baseline results. So we regress the long growth on the monetary policy shock times the technology adoption for each bank. And of course, we control a lot of other variables. And we use the lagged adoption and control variables to mitigate those with the causality concern. So look at the beta 2. If the beta 2 is positive, it means the expansion of monetary policy is associated with a higher lending growth. And if the beta 1 has the same sign of beta 2, then it means the higher the bank's technology adoption, the more responsive of its monetary policy transmission. So here is a regression table. And we see that overall, the lending technology seems insignificant for those response in long growth. However, when we distinguish between the lending and non-lending related ones, we find those lending related ones will strengthen this lending channel, while non-lending related ones will mitigate that. And then here is a local projection of the baseline setting, and we can see the dynamics of the result. So overall, cross-time total tax does not show a significant impact, and lending technology adoption shows a temporary, which lasts for 3 quarters of positive impact. And the non-lending technology related one shows a relatively persistent, which lasts for around 5 quarters.
Yeah.
And then, yes.
You have 5 minutes.
Okay.
5 minutes left.
Yeah. And then we also include those big tech exposure into our regression. And by adding these big tech exposure tilde 1, which is so here in this regression, the tech tilde is the technology adoption that is orthogonal to big tech exposure. And now we consider them simultaneously. And here, the lending related technology adoption still shows a very positive result. So it will enhance the transmission in terms of lending. However, the big tech exposure will mitigate the transmission, and the magnitude is very large. And here again, it shows the dynamics. The lending related one is very temporary, but also the big tech exposure, so it's negative, is also very temporary. And the non-lending related ones, in contrast, they show the weakened impact over the long run. Okay. And then we do the analysis by distinguish different kinds of categories. And in this table, we see that the cloud computing technology stand out, and they have the largest impact in relative to the other technologies. And also we can distinguish different kinds of exposure to big tech. So we have the payment, insurance, money fund, investment, credit, and credit evaluation by the big tech, which is and financial. And in this table, the credit evaluation by those big tech really stand out. So this result indicates that the biggest disadvantage of banks against big tech may lie in the data abundance and the credit risk assessment. And then we do a bunch of robustness checks by using alternative monetary policy measurements, by using alternative technology adoption measurements. Like I said, we use the text-based one, or the pattern dummy, or the term dummy. And we also do a horse race with other bank level characteristics, and the main results are still there. So now let me conclude. Our main findings are that banks' technology adoption play a significant role on the bank lending channel of monetary policy. And we find the adoption of the lending related ones will strengthen the transmission, and non-lending related ones will mitigate that. In terms of technology, adopting the cloud computing technology shows the largest impact. And the exposure to big tech competition will mute the bank lending channel, which suggests a substitution between big tech lender and the banks. So the policy implications from this paper are that monetary policymakers really need to account for this interaction between technology progress within banks and those traditional financial services. And policymakers, they need to further expand their focus of regulating from the financial entities to those specific financial activities. So I will stop here. Thank you very much.
Thank you very much, Xiang, for very nice and clear presentation. And in the meanwhile, we collect a few questions. I have a couple of curiosities. The first one is related to the use of the monetary policy shock, because you have we have in China a period that is up to 2017 in which monetary policy stance was conducted mostly with the aggregate, and you correctly point out to the Xiang paper that stops in 2017. Do you stop the analysis there, or do you then just join the different indicator of the stance of monetary policy with the interest rate from 2018 onwards? The question is if you do a mix, or if you just stop the sample there. And then I have a lot of interest in understanding a little bit more on what are the lending technology, the one that are related to the change in the transmission mechanism and the bank lending channel that are driving the result. Are these related? You said that this cloud computing is very important. But what is the economic mechanism? Because I was wondering if, for example, if a better understanding via credit scoring could be the main driver. But it seems to me that it's more efficiency obtained through different channels. So a little bit of discussion on this would be very, very useful.
A great question.
Please go ahead, and you can answer these two questions. Then in the meanwhile, we'll see if there are others.
Yes. So the first one is about the monetary policy shock measurement. So based on the TENS method, which is basically using the residuals of the M2 growth part, right? And our data is from 2008 Q1, 2018 Q4. So actually we have their shocks in there. And of course, we cannot cover the interest rate, like a reform in China, right, after 2018. So we cannot do that. However, we also provide some evidence using this change in this FR007, which is the interbank repo rate. So just using this rate-based, price-based monetary policy shocks, we can also provide a similar message from our result. And the second question is very good question about the mechanism. So to start with, when we first do this analysis, we find that technology adoption basically does not show some impact on this lending channel. But then we distinguish very carefully whether it's lending related or not. So it shows that the lending related ones, they are driving the positive results of enhancing the transmission. And of course, you would think that maybe it's about the evaluation of the credit risk and the credit assessment. And then relates back to our technology classifications. So among those artificial intelligence, big data, and cloud computing, they can all be related to this credit risk assessment, right? And so based on this technology part, this cloud computing cannot say too much about these mechanisms. But if we look at the exposure to the big tech, we find that the credit evaluation exposure to this big tech shows the largest impact. So this also may have the implication that the channel of the technology impacting monetary policy transmission still lies in this credit assessment part.
Thank you very much for your answer. There is an additional question coming from Manasa Patnam from the IMF, and she asked about the existence of asymmetric effect between period of tightening and period of easing. Now, I don't know if your period is only characterized by easing, or if you have ups and downs.
Yes, that's a very interesting point. So currently, our result does not look into this asymmetric part. The reason is it's difficult for us to distinguish cleanly which period is tightening, which period is easing. And in our period, there are a lot of fluctuations of the monetary policy. So if we define this positive part is easing and negative measurement is tightening, then we will ignore the magnitude of these shocks. But I think that's a valid point, and we really need to find a good way to deal with or provide some evidence in terms of these asymmetric results. Thank you very much.
Just a suggestion, I mean, a simple way could be, if the indicator moves from positive to negative, to take this at face value and to construct a dummy that is 0, 1, and interact the dummy with the interaction and just see what happened. Maybe that this is what Manasa had in mind. But now, thank you very much, and very, very interesting paper, and I am sure that it will meet a very good journal. So thanks a lot. Let's move to the third paper that explores how the use of mobile money can impact economic outcome. And I think that Manasa used the case of India as a laboratory. So the presenter is Manasa Patnam from the IMF. The paper is joined with Weijia Yao. And Manasa, the floor is yours, and you also have 20 minutes.
Thanks a lot, Leonardo, and thanks to the organizers for also, can you hear me?
Yes.
Okay, perfect. Okay, thanks to the organizers for inviting us to present. So this paper is part of the sort of ongoing work in FinTech at the IMF. And we were particularly interested in trying to document whether there were any large-scale economic effects at the macro level, because there's a lot of sort of hype, let's say, around FinTech, but little is known about these sort of economy-wide effects. We examine the case of mobile money, which is, of course, a technology that allows to conduct financial transactions through a mobile phone. This is something, as many of you know, has rapidly sort of spread in developing and emerging economies and sort of in some ways leapfrog the provision of formal sector banking services. We do this in the context of India, which I think Mahima will talk about as well, which is sort of characterized by a large informal sector presence and where considerable transaction costs still exist in terms of banking access and bank intermediation. What we do is we use data from one of the largest mobile money and fintech providers really in India, Paytm, which offers both money transfer and mobile money, sort of money transfer and you know, the way to payment services for consumers and firms. And for firms, these are sort of, and I'll document later, these are mostly sort of informal sector firms. I'm going to lay out the two basic questions that we ask in the paper based on sort of the two use cases of mobile money. The first is whether the usage of mobile money and the spread and the adoption can enable a more cheaper, better way, more efficient way to sort of mitigate against the adverse impact of economic shocks, because it's cheaper and easier to save money and you don't need access to the bank. And the second is, for firms, especially for small and micro firms, does the adoption of this relatively costless technology improve their sales growth because it ameliorates some of the frictions that we know are associated with traditional payment methods, especially cash. So we are placing ourselves in sort of the nascent but still very growing literature on the sort of impacts of fintech, sort of mostly on mobile banking. So the evidence so far has been from literature that has used household surveys in the absence of actual data on transactions. And of course, you know, while this is sort of, there is encouraging evidence from it, one of the issues with household surveys is, of course, is a measurement error, but also that in the case that there is network externalities and spillovers, it doesn't provide such a great gauge of economy-wide effects. And that's what we're trying to fulfill here with the use of sort of this universal data on transactions. Also, in terms of the impact on firms, we think we're one of the first papers to look at this effect of how just a simple adoption of payment technology can have a, you know, could have some big impacts on the ways that firms are able to conduct their business and therefore on their revenue and sales. So what sort of really motivated our study was this sort of setting in India that came about due to a policy experiment, which really basically the adoption of mobile money surged in the aftermath of that. And the policy here was that of the demonetization episode where the government of India withdrew the major banknotes from circulation, which effectively imposed major constraints on cash usage. And you can see in this graph here that literally in days after this policy was announced, there was this huge surge in the adoption of mobile wallets. And Paytm, the company we worked with at the time, was really one of the only players in town for mobile money wallets. And that surge can also be contrasted with the usage of other sort of existing digital products, such as credit cards and debit cards, which actually didn't see the same amount of surge, not even close to it. And that sort of revealed to us some lack of possible demand to these existing products, which are tied to banks, really. So we wanted to take advantage, of course, of this observation that we thought could help us identify some of the effects that we were interested in. So we partnered with this company, Paytm, to obtain their data on transactions between the period, 2016 to 2019, and covering all types of different payments. Now, because, this data is quite big, it covers about 500 million users doing about 1 million transactions a day. We worked with them to sort of aggregate this data to a manageable sort of temporal and spatial frequency. So we aggregated it to the district level per month. And the reason for doing it at the district level was because that is the sort of unit where we also had data on sort of the economic indicator. So now district level data, I mean, in general, GDP data is not available at the district level so readily and at such a high temporal frequency. So what we did was we used a well-validated and accepted proxy for economic activity, which is satellite nighttime data. And then we sort of merged it with sort of an indicator of shock, which is in India, because it's a sort of very rainfall and agrarian dependent economy, it's an adverse event of either very high rainfall or very low rainfall. This is taken from the meteorological department. And then finally, and I'll talk about it later, because we had fully anonymized data and we didn't have any user or firm characteristics, and we still needed to learn about firms, we partnered with them also to conduct a survey and sort of a targeted intervention to sort of look at effects of how the adoption can lead to effects for the firm, and I'll talk about it later. Okay, so before I move on to sort of the main sort of empirical strategy and the results, I just wanted to put forward some of the socioeconomic characteristics that we were able to kind of correlate with adoption and intensity, mobile money use intensity across districts. So to first note is that the one characteristic that we did obtain from Paytm was on the firm identity of whether it was registered or unregistered. And most of the firms, about 94% of the firms that use Paytm are actually from the informal sector, that they are unregistered. In terms of sort of district-wise cross-sectional correlates, we find that the mobile money usage is high in urban areas, but in areas where informality is high. So we take this index of informality from the census, and also where there's a high share of the population, which depends a lot on cash, in fact, such as the youth and the seasonally employed. Okay, so I'm going to go on to the first question of improving resilience to shocks. So what we wanted to see was whether the usage of mobile money, how the cross-sectional use of mobile money interacts with this adverse economic shock, which is rainfall shocks, to help mitigate the negative impact of the shock. So what we're doing is essentially regressing the shock on our measure of economic activity, which is satellite nighttime lights, and then interacting it with the extent of mobile money usage in the district. So we expect that the shock, the rainfall shock, should have a negative effect on activity. So the beta should be negative, but that the extent of this shock should be somehow mitigated and dampened by a district which uses and has a high intensity of using mobile money. And so our hypothesis is that the coefficient delta should be positive. Before I sort of go to the results, just one note on the exclusion restriction in our baseline result is that what we need is sort of the exogeneity of these rainfall shocks, that the timing of rainfall shocks is orthogonal to the adoption of mobile money. But I'll sort of get into that in the next slide. So here is sort of our baseline result. What we find is, as expected, that a rainfall shock negatively affects activity, reducing it by about 18% or so. But we find that in districts which have high mobile money usage, that there is some mitigating effect of the shock. So to give you an idea, if you have a district which doesn't use mobile money at all and then moves to jumps to sort of the median level of mobile money usage, you can almost reduce that shock from 18% to 2%. But of course, that varies across the intensity of usage. Now, going back to the question on the exclusion restriction, of course, there's still a concern for endogeneity that perhaps districts that are accustomed to these kind of shocks have higher risk-bearing capacities, just because this is how they are able to cope with it, and this is why they adopt mobile money more intensively. So to test this, here's where we go back to our demonetization episode. What we do is we basically split the sample into two parts. The pre-demonetization period, where virtually there was not much mobile money adoption, and then the post-demonetization period. So what we want to see is that when we artificially impute all the post-demonetization mobile money averages to the pre-sample, do the results still hold? And if that was the case, then indeed it's true that these districts, where you see some risk mitigation, they're really special in other dimensions, and that they're just simply correlated with mobile money use. And in fact, we don't see that. So in our placebo sample, when we actually artificially impute the post-demonetization mobile money usage, it sort of the results basically collapse, and there's a completely insignificant effect, which basically tells you that this effect really comes once the district has adopted the mobile money use. And then we formalize this through, of course, a more formal regression discontinuity method, which sort of uses sort of the timing of the policy announcement as an instrument. Okay, and just to conclude on this point on mobile money adoption, there's of course different channels through which this effect could sort of be manifested. And one of the two of the main reasons given in the literature is that people are able to save their money through their mobile wallet, and especially those who are unbanked, and then they could use that sort of reservoir of money to aid them when there's a negative shock. And the other more popular explanation is that there's a remittance effect, which is that if you are a family and you hear that a relative has had an adverse economic shock, then you want to help them, and the fastest way to help them is to transfer money. But if you're unbanked, you can't do that. But with the mobile money account, because there's more seamlessness in the way you can transfer, you can do that. And that is how mobile money allows to mitigate the shock, through basically making more efficient use of your network. So because as I said, one of the advantages of having this sort of universal transaction data is that we had information on cross-district transfers. Basically, we had information on all the transactions that were linked from one geographical location to the other. So what we did was, first we looked at the district's money transfers received within a district, and then we also zoomed in on the cross-district transfers received when that district gets hit with a rainfall shock. So when we do that, we see some effect still of using sort of this intensity cross-district P2P transfers measure. We still see some risk-sharing effect, which is almost half the size of what we were finding earlier. So that's sort of indicative that there is this strong channel of remittances, but that there could be other factors in play, such as the mobile wallet and other possible channels. Finally, on this part on risk sharing, because our economic activity indicator is, of course, very, it's constructed and it's a proxy based on satellite lights, we also wanted to validate that using a sort of a more real, let's say, outcome indicator. So we use the labor force data actually to look at household consumption data, and this is typically what is done for most of the risk sharing tests. And then the usefulness about this labor force data is also you can look at heterogeneity. So we were able to split it between rural households and urban households. The disadvantage is that, of course, are temporal. The frequency at which we were observing this went from monthly to quarterly, and it restricted also our time period. But again, doing the same exercise, we find that, again, the rainfall shocks have an adverse effect on household per capita consumption, but that the usage of mobile money in that particular district can mitigate and dampen that shock. But more importantly, all of these effects come for rural households rather than urban. So in the urban set of household set, we don't see any sort of statistically significant effect. And that sort of confirms sort of our original thinking that these are really instruments that are being used by the unbanked, and where that is sort of fulfilling the gap from the financial frictions that they were experiencing. Okay. Let me now go on to sort of the second chapter, which is on firms and how we looked at, whether the payment technology was actually affecting firms. So as I said, the data that we received from Paytm was anonymized, and we didn't actually have any characteristics on what the firms were doing, and therefore could not link it to their sales data. So what we did was that we partnered with Paytm to design an intervention and to do a survey of firms so that we could learn about this. And the intervention that we designed was essentially providing incentives to firms to adopt the technology. And this is something that they actually regularly do. So they offer cashback incentives or, some sort of gifts if the firm were to sort of adopt the technology. And what we asked them to do was to do this more sequentially. So we identified a set of firms at the beginning of the survey period. And then we asked them to provide these firms with the incentives. And then we asked them to sort of target the second set of firms 6 months after. So in that sense, we had, for the 6 months when the first set of firms were targeted, we had a treatment group. And we also had the second set of firms who were being observed at the same time. And that served as sort of, for us, the control group. The firms were randomly sampled by us. We designed the interview questions. And then on a recall basis, we asked these firms also their sales from before the time of the intervention. I just want to note here that, of course, the response rate was low. It was 30%, but what really matters was whether there was a differential response rate between treatment and control firms, and there wasn't. So that was reassuring. And so the basic idea was to look at how the adoption of Paytm through the incentives offered to firms affected the sales growth of the firm that was targeted first over the 6-month period relative to those firms who were not targeted by the intervention and who therefore didn't have any experience with the usage of this technology. So this is the result. So one thing to note before talking about the result is we, of course, check for the balance of covariates across the two sets of firms before the intervention happened. And just the different specification that we have, of course, requires that these two sets of firms, the treatment and control, have a common sales trajectory, which is that in the absence of treatment, there should be no difference in the sales growth of firms between the two sets. And we sort of validate that, happy to talk about it later, through sort of non-adopters sample. Essentially what we find is that firms that were targeted for the intervention for adopting this technology saw about a 24 to 26% increase in their sales after 6 months and after using this technology consistently. We do a bunch of different checks. We, to see whether there are sort of more general equilibrium effects, to see, are these firms gaining their sales by reducing the sales of other firms? We don't really find any, suggestive evidence for that, because we look at sort of how it varies across different locations, across different business types, and I'm happy to talk further on that. In the paper, so these effects are basically intent to treat effects, which is that, this is the effect of a firm that has been targeted to be able to adopt, to incentivize to adopt the technology. In the paper, we also identify average treatment effects, which is conditional on adoption. How much is the sales growth? And that's sort of, it's about, you find that those firms who use the Paytm product actually see firms' sales increase by about 4%. Okay, so I will sort of lay out my last slide here, which is before sort of concluding, one of the other things that we were interested to do with these firms was, because at the time, these mobile companies were interested in offering lending products, credit, and I think that's something that was talked about in the first presentation. They also started to offer insurance products to firms, and that was a very natural sort of linkage with sort of the research question we had. But one of the things we wanted to check was how it affects firms' subjective expectations, the uncertainty about their future, their optimism about sales. So we derived and we elicited subjective expectations, and it actually worked out quite well. You would think it's hard to ask firms, about their standard deviations and mean forecasts, but they were the response on that question was quite good. So once we had that information, we were able to basically fit these triangular distributions and elicit, the mean and the standard deviation of future sales that each firm expected. And what we find is that for those firms, the treatment firms, firms that were targeted by the intervention, they had about a 22% higher future sales expectations, so they were more optimistic. And they had lower uncertainty about their future sales, which is something that's actually linked to a higher actual sales. So by reducing uncertainty, you've actually helped firms to sort of raise their actual sales. And this was also linked to the likelihood that when these firms lowered their uncertainty, they were able to take out more bank loans. And that's something that we asked and we captured. Okay, so I'll just conclude by saying, so what we try to do in this paper was to leverage sort of the universe of transactions using this one company that was one of the only players in this sort of setting that we just defined to see whether there was any economy-wide effects, more macro effects, real effects of fintech. That was something that has been flagged by some of the survey data evidence. And indeed, we find, as these papers do, there are large economy-wide effects. It does mitigate the negative effects of the shocks that especially rural households who are unbanked face in India. And that these technologies also can have very good effects for very small firms and small informal sector firms that, I find it hard to actually, frankly, use cash or need to pay really high surcharges with the use of credit and debit card. I'll stop.
Thank you, Manasa. It's a very, very interesting paper and also very timely with all this discussion that there is between improvement in payment services and real effect. I found very well defined the research question, also the test. I was wondering, looking at your last slide, I was wondering if real effect would be higher if there is a subsequent link between transaction data and then the offer of a loan. Because what we observe in China is that by the use of the QR code, then the big tech, they can get access to the data, transaction data, and then together with payment services, then as a second step, small and medium enterprise or vendors, they then have access to credit, and this could be the case in India as well. Let's see if there are a few questions. Let's check the chat. If not, I have another curiosity. If because in India is a special case, and there is really the adoption of face payment system and a lot of an impetus in the improvement of the system, also using a system for identity to improve the identity. So is this something that you plan to explore as well as a form of technology adoption related to payment? And what is for the Indian case the link and potential additional real effect coming from these additional improvement on payments?
Yeah, no, thanks. So maybe I can actually just touch upon the first remark that you had on credit. And so just to say that it's actually, it's a complicated question in India on credit, primarily because there are several, even though people who don't have access to banks, there are several informal ways to access credit through the existence of traditional money lenders, or there's actually a huge microfinance market in India now that actually is now starting to offer, using fintech, these credit services. But actually the literature on microfinance in India is quite negative, or at least the recent literature has been, because there's sort of a lot of this concern on predatory lending. And so indeed, it's not clear to me yet whether the offer of credit through these companies would just mimic something that the microfinance lenders have been doing who have not been regulated, for instance, versus something like banks, although now these fintech companies are starting to get regulated. So maybe, you know, it could actually end up having a positive. So I think theoretically, this just seems a bit ambiguous. On the second question on the digital ID, so we have sort of a companion paper on this, which is more descriptive on, you know, this new technology that India, the central bank has sort of pioneered in what's called the India Stack, right? What they're trying to do is bring together digital ID, the existence of non-bank and bank providers, and then of course, rights to data management under one common infrastructure platform. And that I think, I mean, how this links to our paper is that when we were working with Paytm, they were in the process of becoming a bank. So we have special licenses for these fintech companies in India, which are only deposit-taking banks. And my experience from sort of, you know, talking to them at the time was that infrastructure that was offered by the public authorities really helped them, because not only could you now transfer money from your wallet to another wallet, you could transfer money from your wallet to another bank quite seamlessly. And that what underlined it, of course, was the digital ID. You know, to be able to verify and authenticate and do all these transactions, you need sort of a foundational layer. And you know, well, this is something that you know, the Indian authorities have been quite keen on working. So yeah, I don't know if that answered your question.
That's a very, very interesting avenue of research, I think. And you're well positioned. You already started the paper. There is a question by Julapa, Jagtiani, that referred. The question is: it seems the rise in sale did not impact other firms. Does it imply that Paytm increased overall consumption?
Sorry, what I wasn't.
So the question is if the use of Paytm increase overall consumption, then you cannot distinguish between, you know, the clear effect between the firms that use it or other that they don't.
Oh yeah. So this is what I was sort of talking about earlier. So we do in the paper distinguish between those firms who were targeted to were incentivized to adopt, those firms that actually didn't adopt at all, and those firms that ended up adopting the technology. And on average, actually, it seems that firms have about 4% of their sales is linked to you know, taking transactions through this Paytm technology. And yeah, I mean, the effects are smaller, of course, because there are of course firms that don't use it at all. Yes, exactly.
So Julapa pointed out that could be also there could be also a general increase in overall consumption, maybe motivated the adoption of the. Okay, thanks a lot. Very, very nice paper, and we can now move to the fourth paper that is another excellent one. It explores if digital financial services have made access to finance easier for women, helping to broaden their financial inclusion and close the gender gap that we observe in the literature, especially when we look at the banking services. So the presenter is Mahima Vasist, University of California, Irvine, and the paper is joined with Ratna Sahai, Purva Khera, and Sumiko Ogawa. Mahima, the floor is yours. You have 20 minutes. I guess there is Mahima, can you? Yes, I can.
Okay.
And I can also see the
Okay, great. Thanks a lot,
now
Leonardo.
I can also see you. I can also see you.
So thanks Thanks everyone for the great presentation. As we all probably agree upon, Fintech is great and it's here to stay. The aspect of Fintech that we touch upon in this paper, which is joint work with Purva, Suniko and Ratna, is to investigate what the participation of women looks like in this industry, both from the supply side as well as the demand side. So the motivation for this paper is mainly twofold. So firstly, we know that there's been considerable progress in financial inclusion in the past couple of decades, but sadly, the gender gap in the traditional financial inclusion still persists. So several barriers have been identified for the same, mainly, for example, distance to the bank, women having insufficient bank-related documents, or cultural scenarios prohibiting women from accessing these services. These have all probably contributed towards the persistent gap in traditional financial inclusion. However, there's been recent work that suggests that financial technologies can especially help women to overcome these obstacles. Indeed, there's been recent work by some of the co-authors who find that fintech has been the main driver of financial inclusion in the recent years, and it has especially been very effective in closing down gender gaps. However, that's not the case everywhere in the world. So some countries have seen gender gaps in financial inclusion reducing because of fintech, and some have been seeing that the gender gaps have been widening. Given that we are now facing this crisis, induced by the COVID-19, it could indeed accelerate the adoption of these financial technologies. And we need to be very, very careful about ensuring that these inequalities are not amplified. And digital financial services can play a huge role there. The second motivation comes from this extensive literature that sort of believes in the fact that women and men invest differently, women and men handle money differently, and they make financial decisions differently. Indeed, there's been research that finds that higher representation of women in bank boards leads to greater financial resilience of these institutions. However, despite that, there are large gender gaps in representation of women in leadership positions in such banking, supervising agencies and the banks. So what exactly does all of this mean for the fintech industry is what we try to explore in this paper. Having said that, the key questions that we ask are as follows. So from the supply side, we ask if we first document what the current state of women entrepreneurship looks like in the fintech industry. Next, we ask if greater representation of women in leadership positions has any economic implications for these fintech firms. So we measure whether companies that have higher female representation, whether those have better firm level performance. From the usage side, we ask, firstly, what are the drivers of gender gaps in digital financial inclusion across countries? And to tie it up all together, we ask if there is any relationship between countries which have higher share of women in leadership positions in the fintech industry, and whether that in turn impacts the gender gap in digital financial inclusion in those countries. So our key findings are that from the supply side, indeed, participation of women in the industry is abysmally low. It stands at around 10 to 15%, which means that 10 to 15% of the firms were in fact founded by women in the last 20 years. And if we were to go beyond the founders, even if you are looking at women in corporate boards of these firms, the average share of women in executive boards in these fintech firms is less than 10%. Secondly, once we control for the country in which the firm is located, the year in which the firm is established, what the size looks like, we still find that indeed there are economic implications from gender diversity. So we find that firms that have higher share of women on their executive boards, they do perform better. And the way we measure firm performance is by looking at how much funding they're receiving and how much revenue they're earning. So we find that firms which have higher share of women on their executive boards receive higher funding and they earn a higher revenue. From the usage side, we find that the gender gaps in usage of these digital financial services across the countries are driven by primarily gender gaps in financial literacy, then gender gaps in digital literacy, and there are socio-cultural factors that really drive these differences. And then lastly, we find that it is not just the case that women are great for firm level performances. There are indeed great spillover effects. And we find that countries which have higher female leadership in the fintech industry, they have lower gender gaps in mobile account ownership. So let's dig right into the first part of the paper, which is the supply side, where we ask what the women's participation as leaders in the fintech industry looks like. So to answer this part of the paper, we make use of this really interesting and novel database where we have firm level executive board data in the fintech industry all over the world from this database called the Crunchbase. So we have firms that are located in 97 countries across in the world. We have like two parts of this data set. The first part has descriptive information on fintech firms. So we have data on about 12,000 firms, 12,000 fintech firms. We have information on what their size looks like. So number of employees that they have, what revenue they're earning. We know where they're located exactly. We know when they were established, and we know what the last round of funding they received. So in absolute numbers, what was the money, how much money did they receive as funding in the last round? Now, the second part of this data set is the one that comes from the executive data, where we have information on 28,000 individuals who are associated with fintech firms. And these 28,000 individuals are located in over 9,000 firms. So from this individual level data set, we know what the name of the person is, we know what the gender is, which companies they found, and what their education background looks like. So essentially what we do is we merge these two sets of data sets together, and we have a final data set where we have 14,000 information on 14,000 individuals in 5,000 firms across the world. Now, one thing worth noting before we move on is that this data set is just a snapshot. So we do not observe the trajectory of each firm over time. So let's say a firm that was established in 1900s. We don't know what the gender representation, what the revenue, employment looked like back then. We only know what it looks like today at the time at which the data was downloaded. Moving on, given how nascent the fintech industry is, indeed, majority of the firms, so like 88% of these firms were found in the last 10 years. So it's very, very nascent. And only 10 to 15% of these firms were found by women. And there's like interesting geographical variation in where these firms are set up, which could probably be driven by what the existing financial system look like. So countries, for example, most of the fintech firms are situated in the Western countries in the Western Hemisphere. 34% of them are located in Europe, 17% in Asia and Pacific, and the rest are in Africa, Middle East, and Central Asia. Now, this could very well be driven by the fact that Western Hemisphere sort of took the lead in having well-established financial systems, and therefore would make a swifter jump to having fintech firms established. Secondly, we find that if we were to look at the moving average of fractional women executives over time, now again, remember, these are this is just the snapshot. So we only know what the representation of women looks like today for firms that were established at a particular time period. And we find that average share of women in executive boards is indeed, we can see the levels are consistently lower than 10%. But the good news is that it's increasing over time. However, what is sort of worth considering, what's sort of a red signal, is that this this representation is even lower than the representation of women in the technology firms and in the bank boards. So when these two sectors are coming together, indeed we see that the gender gaps are widening and is a cause of concern. Interestingly, the cross-country variation again looks super interesting here. So Middle East and Central Asia, firms in Middle East and Central Asia have higher than the average share of women in executive boards. Western Hemisphere sort of comes second with 12.5% of fraction of women in executive boards. And Asia, Pacific, Africa, and Europe combined have around 11% share. Next, we see what how the fraction of firms where a woman, which were founded by a woman, varies with the size of the firm. So given that these firms are all super new, fairly new, majority of these firms are small size, so they have less than 50 employees, of which just less than 15% were founded by women. And it is also clear from this graph that women are more likely to be founders of the smaller size firms. And one could also sort of see here or argue here that it is these small firms that also may be earning lesser amount of revenue and may be receiving lower amount of funding. So there's a clear, there's like an interesting mix of the firm size, the revenue they earn, and the gender of the founder. Next, we find that, interestingly, we find the opposite result for share of women in executive boards by the size of firm. And we find that it's the larger firms where the average fraction of women executives is higher. So once we get rid of the outliers, the large firms have higher share of women in the executive boards. Again, these large firms are possibly the ones which earn high revenue and they receive higher funding. So as we can see, it's not very clear on whether we can say that having women on board or having a woman founder leads to a better performing or a worse performing firm, because that has got to do something with the size and where they're located. Having said that, we estimate a simple fixed effect model to try to get at this relationship. So we measure firm performance, as I mentioned, by looking at the revenue that the firm is earning and the funding that the firm I that was found in year T is receiving. We have a categorical variable as our outcome variable. So if the revenue or the funding is less than $10 million, it's the lower, it's a small firm. And if it's earning greater than $100 million, we categorize it as a high performing firm. So we look at the impact of whether the firm I in year T was founded by a woman, either solo or co-founded. Then we look at whether the fraction of women on executive board in that company has got a role to play. Given that size of the company is important, we control for the size of the firm by, again, categorically. So it's a small firm if it has less than 50 employees, and it's a large firm if it has more than 250 employees. Given that there is interesting variation in how these firms have sort of come up over time, we control for year fixed effects to sort of do away with any year-specific impacts on firm performance. We control for country fixed effects to do away with any country-level financial system effect which could drive our outcome variable. We estimate basically two set of models here. The first one, we just do a simple OLS. And we find that when we have we find that a higher fraction of women in executive boards indeed increases the probability of earning higher revenue. However, because this is an OLS regression and the outcome variable is categorical, we cannot make much sense out of these coefficients. So we also estimate an ordered logit regression, where again less than 10 million is a low performing firm, and higher than 100 million is a high performing firm. And we find that having a higher fraction of women executives on the firm board leads to there's a higher chance that that firm earns a higher revenue. However, this result is not super significant. Having said that, the odds of being a high revenue firm is in fact 75 percentage points lower if the firm is founded by a woman. which is sort of contrasting, which was signaled from the descriptive data as well. But we shall try to dig into the mechanisms in a second. Secondly, we find that we have consistent results for the funding as well. So if the percentage of women on executive board increases by around 10%, the odds of that firm receiving higher funding goes up by 1.3 to 2.7%. And the odds of receiving the high funding, in fact, is 77% lower if the firm is found by a woman. Now, this opposite result is sort of interesting, but it could be driven by the fact that there is a gender homophily which affects firms, which is to say that when there's this literature that finds that when the gender of the investor is different from the gender of the firm's founder, there is, in fact, a lower funding that is offered to the firm. And given that we have low share of women in the investors as well, this is probably what would be driving it. Secondly, there are also a huge gender bias in the questions that these investors pose to the entrepreneurs. So for example, women are asked really protection-based questions at the time at which they apply for the funding, whereas men, sort of founders who are men, are in fact asked questions which are super ambitious in terms of how are you going to ensure that your firm performs great, blah, blah, blah. And however, women are asked questions like, okay, how are you going to ensure that there are no losses? How are you going to ensure that your firm doesn't face any sort of problems? Moving on to the usage side of the story, we estimate a random effect panel regression model to see what exactly is causing the gender gap in usage of digital financial services. So we make use of this digital financial inclusion index that was constructed by my co-authors in another paper, which is basically the percentage of difference in digital financial inclusion index between men and women in country I at time period. We look at the first variable of interest out here is the gender gap in upper secondary education, which we are taking as a proxy for digital literacy. Sorry, which we are taking as a proxy for financial literacy. Second variable of interest out here is that we're looking at the female share of graduates in STEM-related fields in country I in year T to proxy for digital literacy. We control for the share of female to male labor force participation rates. We control for cultural and socio-cultural conditions in the country by controlling for the Women, Business and Law Index that comes from the World Bank data. And we also control for the real GDP per capita of the previous year. And again, control for year-end region-specific fixed effects. So when we run this model, we find that indeed digital literacy, financial literacy, and socioeconomic culture matters. So when so a 1% increase in gender gap in upper secondary education indeed leads to a decline in it increases gender gap in digital financial inclusion by about 3%, which is quite high. On the other hand, when the share of women graduates in STEM education decreases, when it increases, which is to say that women, there's higher digital literacy for women, that leads to a reduction in the reduction in the gender gap of digital financial inclusion by about 0.2%. And again, if the cultural conditions improve, then again, so when the World Women Bank and the Women, Business and Law Index increases by 10 points, then which is to say that gender equality increases by 10 points, then the gender gap in digital financial inclusion indeed declines by 1%. Now let's tie it up together and see whether these differences in the usage of digital financial services can be impacted by the share of women in leadership positions in the countries. So we run a very simple model here. We are sort of running against data issues out here. So we sort of look at gender gaps in mobile account ownership in 2017. The data for this comes from the World Bank Findex data. And we control for the fraction of companies in the country that were founded by women, and the fraction, what the average fraction of women in the executive board looks like in that country in the previous year. And we control for gender gaps in mobile ownership, again in 2017, and control for the country fixed difference. And indeed, we find that when there is an increase in the fraction of companies that are founded by women by about 10%, that reduces the gender gap in mobile account ownership by about 0.4 percentage points. Given that the average gender gap in mobile account ownership stands at 32% as of now, this in this reduction by 0.4 percentage points is not small, I would say. And similarly, when there is an increase in fraction of women in executive boards, even then we see that there is a reduction in gender gap in mobile account ownership. Now, again, there could be several mechanisms at play, but the ones that are sort of well-founded in the literature are the fact that having more women could lead to better firm performance, which is also what we found, which could lead to better financial services, better, which could impact how the users are adopting those technologies. There's also evidence that women target different kinds of markets, so they target different kind of users. So having more women could lead to better outreach for the women users. And of course, there are these role model effects that also dominate. Having said that, given that fintech plays a huge role in furthering financial inclusion, especially in the world that we're currently living in, our paper sort of has several key policy implications. First, as we saw, it is pretty crucial to invest in digital and financial literacy on part of the governments, as that would ensure that there are lower gender gaps in usage of digital financial tools. Secondly, given that mobile account ownership, given that mobile ownership as well has a role to play, we need to ensure that digital infrastructure is sort of ramped up a little bit to avoid exclusion due to the existing digital divide. We need high focus on increasing representation of women in STEM-related fields, which is not only going to ensure that there's higher representation of women in this industry, but also it's going to ensure that more women are going to uptake such services, which have great benefits. Fourthly, there's a huge need to improve visibility of women founders, as that could unleash the benefits from having women founders in the industries. And lastly, I would end by saying that the governments need to collectively create incentives, not just for women to participate in the sector, but also for men in order to improve the representation of women in the industry. Thank you.
Thank you very much. Very, very nice paper, interesting. It has already stimulated a lot of interest. There are already 2 questions for you. So let me just tell you the question by Aye Bande Amadi. The first one is the following. I don't know if Aye, do you want to step in and raise the question in person? I don't know if the operator can let Aye. If not, if it is a problem,
try together.
Can we have Aye? Aye, do you want to raise your question in person? Well, I'll start with the first one because it's written quite clearly. So when I work at Kickstarter, I found that women took on projects with lower funding goals, but had higher likelihood of meeting their goals. I wonder if there is any way to look at whether females take on founding fintech firms that are smaller or less risky, perhaps by looking at the verticals of the firms in the dataset or through other means. And this is a very interesting question because I think that despite the fact that you have all fintech firms, among the fintech firms there could be different kind of fintech firms, and maybe that you can distinguish between the various type of fintech firm. Let me just tell another question. Is about the nonlinearity. Have you looked at the nonlinearity in the trends identified? For example, whether a falling share of women getting educated in STEM or in leadership roles has a different effect than increasing the share, or whether the trends are different by country, since there is a lot of systemic stuff. How long women have been in leadership role, regulatory requirements, cultural differences that might not be measured here. And the third question I have always from Halle is, can you comment or might you be able to look at the time frame on which some of these trends, education, representation, start to make impact, and time frames on which they have max impact? So
Halle should be able to speak now.
Okay.
I think you did a good job summarizing my questions. I thought this is very interesting work, and maybe some of these are directions for expanding it, but basically, yeah, let me know if you need me to clarify. I'm gonna let you answer.
All right, thanks a lot, Aya. Those are really, really interesting questions. For the first one, there is in fact evidence that says that women do end up taking lower funding goals because that's and they end up achieving those goals better. And indeed, we also find that in the descriptive statistics that it's the lower funding firm and the smaller firms where more women are situated. So the graphs that I showed for the size of the firms, we have like very, very similar graphs when we plot the share of women against funding. So it is in fact true that firms that are founded by women are the ones which receive lower funding. But having said that, the fact that the interesting thing out here is that even when we control for the size of the firm, which is sort of correlated with the funding situation, women do end up having firms which are founded by women do end up getting lower funding. And I mean that's like the key thing out here on how is it possible to measure that, but we sort of run against limited data. We do not have much data in terms of how to see what kind of investment projects they are taking up, what exactly the negotiations between the investors looks like, and all those things. So it is pretty interesting, and like it is really an open question. I don't think our data allows us to really get into the mechanisms deeper. I'm not sure if if I answered your first question before I move on to the second one.
There are some databases that I think provide some information on startups that might give you a sense. I can't remember if it's Crunchbase or like Capital IQ. I used to do a lot more work on startup stuff that might break out like the sub-industry or just like textual analysis that would allow you to kind of identify what space it's in, what competitors there might be, and that sort of thing. But I mean, obviously that's a separate study. I just think it's like a really interesting thing to be able to combine with what you have.
Yeah, no, sure. So even from this database, we do have information on what type of fintech firms these are. So there is information on what exactly this firm is, whether it's financial services, whether it's technology, but those categories are super overlapping, but definitely worth investigating. I'll definitely take a deeper look into what the competitor scenario looks like. On the second question, looking at non-linearities in trend, yes, the models that we've estimated are pretty much linear, and I think we could indeed figure out a way to see whether non-linearity does matter. But to see whether the trends are different by country, they are. So one very interesting scatter plot that I did not show in my presentation because of lack of time, there is a lot of cross-country variation when we're looking at share of women in STEM and plotting it against share of women in the industry. And if you're looking at the gender gap in digital financial inclusion, the scatter plot seems to be way more prominent for the users side, but looks, while there is a lot of variation for the supply side, but it's sort of compact there. So despite having variation in STEM education, share of women in STEM education across countries, the slope of the share of women in the fintech industry is not very high. It's negative, but it's sort of flat. So when firms are, sorry, it's positive, but sort of flat. So it is interesting. I'll definitely look into the non-linearity aspect of that. And then lastly, yes, that's excellent to, I think that is really crucial for policy implications as to when is it that these things matter, whether it's at what exact stage does STEM related education matters, whether it's at the lower stage or whether it's at the higher stage. I think it's worth sort of looking even into the PISA data set to know what the financial literacy looks like, or what the digital literacy looks like across countries for different age groups of these users. But it's a pity that the data set that the countries that we have in our sample are sort of completely distinct from the ones that are interviewed under the PISA data set. But if you have any other suggestions on the databases that we could use for answering this question, that would be great.
Have you tried looking at just different, I don't know what years of data you have, maybe I missed that, but have you tried looking at just different kinds of like information criterion and lags to look at what kind of lag structure shows up and seems to, just within the variables you already have?
Yeah, so we actually use the digital from the usage side. We have the data between 2014 and 2017. So it's 2 points in time. So we are in fact making use of variation that's happening in a country between 2014 and 2017 on all of these indicators of STEM education, upper secondary education attainment and stuff like that. The key thing out there is that our outcome variable does not go before 2014. And not much information on gender gaps in uptake of digital financial services is available from before that. So hopefully moving forward, when World Bank makes available new data and when the latest Fintech survey is updated, I think this could be extended to see exactly at what point in time.
You could try to break out the set into countries that have had, a long history and ones that didn't, and just look at those two groups that way.
Yeah, that's interesting.
Thank you very much, Maima, and thank you very much, Halle, for this very interesting discussion. So we're at the end of this session, and on fintech and financial inclusion, I think we had a very good discussion with a lot of very good comments and suggestions for the others. I would like to thank all the presenters, that is Julapa, Xiang, Manasa, Maima, and also let me thank also Halle for his intervention and comments, Ricardo who raised a question, Igor who has also helped us in the technical part. So thank you a lot everybody for your participation, and stay well, and let's hope to see you soon.
Thank you, Leonardo.
Thank you.
Everyone.
Thanks a lot.
Bye.
Bye.